Hello everyone. I know it's been a long day and you're near the end of it, so hopefully some of you are still awake. Thank you for inviting me to today's conference. I want to begin by really thanking and applauding the Chamber for today's conference and all the work it's doing to support innovation and training and workforce development, to help people access jobs that pay a family-supporting wage, and to help those with barriers to employment enter the labor force, because this topic is really near and dear to the Federal Reserve Bank of Atlanta. In our role as part of the nation's central bank, we think a lot about how to pull more people into the workforce in order to grow our economy. So before I begin my remarks, I have to say these remarks are only going to reflect my opinions. They don't reflect an official position of the Federal Reserve Bank of Atlanta, the Federal Reserve System, or the Federal Reserve Board of Governors. But I know those of you laughing because you've heard Fed people speak before. But what I hope to do in my time is to get you to think and imagine the role finance could play in all the transformation and innovation that we've heard about today. We at the Atlanta Fed have been asking that question lately, because when we look out at the training ecosystem across the US, we see a lot of money being spent by individuals, by employers, by governments. But questions still remain about whether that money is being spent efficiently or effectively. I wish I could see heads nodding when I say that, but I assume you're nodding your heads. Workers bear a lot of risk in today's system, but they're willing to invest in themselves, we know, because student loans just keep growing. But we all agree that students don't have the information they need to make the best decisions regarding their training. And training programs are still, for the most part, paid for the proverbial butts and seats, rather than paid based on their track record of helping their students get a quality job. But there are good, high-quality trainers out there who do have great outcomes. It isn't all unscrupulous trainers trying to hoodwink employers and students. And employers, the employers who sit here in the room, estimates say you're paying upwards of $500 billion for training, but most of that goes to higher skilled employees and isn't being spent on the frontline workers who could fill some of the middle skill job gaps. So we're left with a world in which workers are frustrated that a 40-hour week doesn't support their family. Employers are frustrated by the inability to hire workers with the right skills for the available jobs. Quality trainers are frustrated that they can't get funded to scale, and then us taxpayers are frustrated for how poorly our public dollars seem to be spent. So how do we escape this dystopian nightmare? It's not quite that bad, guys. It's not like The Handmaid's Tale, okay? But I do think one of the answers could be finance, because financial products can create incentives to drive behavior change and can also help shift risk between players in a system. So as you continue to examine the changes you're trying to create in the talent marketplace, I want you to consider if creating new financial arrangements between the players could actually help you improve outcomes, change the incentives, or better allocate risk between the four key stakeholders in the system: the individuals, the employers, the trainers, and the governments. And as you think about the what the financial arrangements should be or could be, I want you to also consider whether it makes sense to use finance instead of funding to pay for this innovation. How many of you have heard people talk about that distinction before? All right, not too many. Because we all know there is an increased demand for training in today's labor markets, and yet public funding has gone down over the years for workforce development, which suggests there may be a need to attract private capital into the system. And finance can be a really nice tool to help you bring private capital in. Today, a lot of workforce development is really oriented around funding. Pay me for a service, do not expect a return on capital. But could there be a benefit to a world in which more workforce development and training services shift towards financing, where some financial return is expected over time? Could that actually yield some social benefits, including promoting income gains for lower wage workers? That question of how to create financial products that generate both socially beneficial outcomes and that is really the focus of my work at the Fed. I'm actually not a workforce development. I study social financial markets and these so-called double bottom line strategies where you want financial and social returns. In the world of social finance, there are groups of investors who are looking for a social return, not just a financial return. Those investors can be philanthropy or government who are willing to take a lower financial return or a higher risk because social return is part of the upside. But they can also be corporations and employers, as the prior panel, I think, really highlighted nicely. So Andrew, it's not a full cop-out that you took. I'm gonna help rehabilitate that. In the world of social finance, we also think about different ways to try to quantify the financial returns of an investment. Some private investors want an interest payment or capital gains as their return. Other investors actually quantify savings as a return on investment if you can help them reduce an expense. Some investors want a really, really high yield, so think your traditional equity investors, and others are happy with a small but stable income stream, and that's where we bring in like bond investors. So could the social finance world help support the transformations underway in the talent marketplace? Well, the Atlanta Fed, we think that was a good question to ask. So we brought together a group of experts in each of the fields, in the training and workforce world, in the social finance world, for a meeting called the Financial Innovations Roundtable back in April. And we co-hosted that meeting with the University of New Hampshire and the Board of Governors. And a number of people in this room were actually at that meeting. And they talked about the possibility of the two sectors working together more, given they both share an interest in improving economic outcomes for underserved communities. Well, because of that conversation, it has led the Atlanta Fed to devote more work to issues of funding and financing and workforce development. So we have a Center for Workforce and Economic Opportunity. You can check out its website at frba.org/QIO, and we've set up a page in a whole area of work we plan to do on this funding and financing question. You can read some of the stories from the conference there and start to get a better picture of how finance can help to support these transformations in the talent marketplace. But I'm going to review a few examples from our conference with you. So earlier I said workers are bearing too much risk in our student loan-fueled training system. Well, what if you had a lender that was underwriting the student in a more responsible way? Well, that's what Freedom First Credit Union does. They're a credit union in Roanoke, Virginia that serves a mainly low-income population. And they provide credentialing loans to help workers get a truck driving license. They identified a high-quality trucking school and knew the incomes for graduates of that program were good. So they created an unsecured loan of about $4,500, paired it with financial education and budgeting classes to further bolster their borrowers' ability to repay the loans. The course takes 20 days, has a 91% job placement rate, and the student has 3 years to repay the loan so that the payments are affordable for them. If you talk to a lot of credit union execs, a lot of them have under $5,000 unsecured consumer loans. So this is a very scalable model. Some complain that trainers aren't incentivized to achieve outcomes. Well, what if you paid them for those outcomes? Well, that's what the state of Virginia does in their Workforce Credential Grant Program. They give pay-for-performance grants to community colleges for non-credit training programs that lead to an industry certification in an in-demand field. The student pays 1/3 of the cost of the training, so they have skin in the game, and the state pays a community college the next third when the student completes the course, but the last third when they actually pass that licensing exam. They saw completion rates of 97% in the program's first years, and the average cost to the student has just been $900. What if you have an effective training program already and you're trying to scale it? Well, if you have a public funding source for that, you could try social impact bonds, which Massachusetts has been playing around with Jewish Vocational Services. They worked with the organization Social Finance to raise $12.5 million from 40 social investors, and that has allowed JVS to expand one of its programs to 2,000 additional immigrants and refugees in Massachusetts. The state's going to pay back those investors only if the program achieves a set of agreed-upon outcomes, which includes earnings growth for the participants. And the state took the extra step of using its administrative data to help track that wage growth, since we all know that once somebody graduates from a program, it's hard for the trainers to track that outcome. And if the scaling doesn't work, the social investors are the ones who bear that financial risk, not the taxpayer. So what if you're in a place where you don't have public dollars on hand, but you still want to scale? Could you get purely private capital to do it? Well, First Step Staffing in Atlanta has done that. They're a nonprofit that buys for-profit staffing firms, converts them to nonprofits by accessing financing from social investors. They reorient the staffing agency to support hard-to-employ populations like those with criminal backgrounds, homeless individuals, and vets. And the capital from some of their expansions has come from the Nonprofit Finance Fund, which itself is a nonprofit and a community development financial institution, or a CDFI. The reason I bother to explain to you what a CDFI is it's a Treasury-designated certification of financial institutions that really focus on serving low and moderate income or underserved communities, and they really specialize in helping develop these kind of social financial products. Freedom First is also a CDFI. So in closing, as you go about trying to create innovation and disruption, inspired by everything you're hearing at today's conference, I hope that in my brief remarks, I helped you better understand how funding and financing could be a tool in your toolbox. I know new models won't be adopted wholesale immediately. We're going to need demonstrations and testing of concepts and ideas, and I think that many of you in the room today are primed to do that and are already doing that. And it's also going to take partnership across sectors to create these financial products and build new service delivery models. As you consider if a financing strategy could work, think about the value creation that may be generated by a given training activity. Can you quantify that value creation? Because then someone in the social financial system might be able to help you finance it. So if a social finance person is looking at a training program, they may ask, is the employer going to make enough money to be willing to pay for the help? Or will an employee's salary increase in a predictable enough way that I can lend against the future income stream? And finally, they could even say, is society going to benefit perhaps from decreased incarceration rates or decreased public benefits usage? So maybe we can figure out a way for government to be the payer. But remember that the social financial system does not operate with private capital alone. It often requires public investors and philanthropic to achieve that double bottom line. And employers, you have balance sheet that you can deploy creatively to invest in the new training marketplace. And I was talking to Peter Beard earlier, and he says he has loads of examples, so go find him to talk about that. And not all challenges can really be tackled through a double bottom line. We have to admit that, even as I'm trying to get you to think about financing. Sometimes only a purely social investment is possible, which means philanthropy or government will need to be the payer, and a financing mindset won't really work. And really listening to Will talk this morning, I think really underscored that some of the supports people are in need are purely philanthropic. And finally, as you try to build new talent marketplaces, I invite you to reach out to us at the Federal Reserve Bank of Atlanta and at our Center for Workforce and Economic Opportunity, and let us know how we can be a thought partner in helping instigate these innovations in funding and financing and workforce development. So thank you.